Hi, this is Greg. Welcome to the channel. A few months ago, actually October 10th, I did a breakdown and an analysis of Exxon Mobil Corporation, and it got, at least for me, quite a lot of views and quite a lot of interest. And I got some messages, emails, and comments to do an update on that position and on that recommendation. So that's what I'm going to do, and it's coming to you right now. Okay, so when I originally did the analysis on Exxon Mobil Corporation, the stock was quite a bit lower, and since then, last 2 months, it's basically done nothing but go up. And I'm happy about the fact that I jumped in around the time when I recommended it. I bought around $33.50 a share. I bought a nice big slog of it. And I'm very happy that I did because the stock's up about 24%. And then on December 10th, I'm going to get my first quarterly dividend. At the time I bought it, the annual yield was 10.4%. So I'm pretty happy camper. But the question is now, is it still a good time to buy this company? And if you were to buy it here or maybe a little bit lower or a little bit higher, would it still be a good investment over the long term? Now, I said in the original video, which I'll put both in the description and at the end of this video, I said that the real reason to buy this stock at this point in time is for the dividend. And I spent most of the original video going through why I thought Exxon Mobil had the ability to maintain the dividend even at extremely low oil prices. We proved in that video that their balance sheet is only leveraged about 35%, maybe 40% if you include short-term debt. And while it's not quite as good as Chevron, which was only 25% leverage, which is absurd and ridiculous, they have plenty of firepower to borrow if necessary, or, as we discussed and also Darren Woods discussed in his interview on that first video, that they have the ability to cut their capital expenditures to protect the dividend and to provide enough capital so that that dividend can be paid out quarterly and possibly even expanded if the situation improves. So as we come back now and look at it, has anything really changed in our basic investment thesis? So right now what I'm going to do is I'm going to share my screen and let's just take a look at the chart and see what conclusions we can draw from it. Okay, so here's the basically the chart, and you can see it goes back to the beginning of the year. Right around here was where I recommended it on the first video, and that was around $33.50. Since that point in time, it's gone up to $40.90. It closed at today, which is December 7th. And so it's had a nice run. It's up, 24% since it was purchased, and it was a little bit higher. It got up to 42 for a couple minutes there. So the question is, originally when I recommended it, the dividend yield was 10.4%, which was very nice and very juicy. But now it's around 8.6, 8.4%, somewhere in there. Okay, so the question is, at these levels, $40.50, is this something that, $40.90, is this something that we want to jump in on now, or do we want to see if it goes into this seesaw pattern again and we can potentially buy it lower? Okay, so that's really the question. Okay, so let's pop over to my trading account here. As you can see, we have Exxon Mobil up on the screen here. It looks like it opened at 41.42 and it closed at, well, the previous close was 41. Okay, it closed at $40.90 up here. Okay, so I again recently did a video. I'll put it in the description below, where I talked about different technical trading strategies that I use for looking at various stocks. So let's take a look at that, and we'll see where the stock is in relation to some of these technical measures, and see if this is something that we want to jump into now or we want to wait a little bit. So let's pop over to this chart. Okay, some of you, if you watched that video, if you haven't, you should watch it because I go into tremendous detail. I won't go into that level of detail on this video, but I just want to look at where the stock is now relative to these various measures. And up here we have the Bollinger Bands, right? The upper band, which indicates overbought, the bottom band, which indicates oversold. You can see the stocks right here. So it's above the moving average, but it's not radically in an oversold position yet. Okay? Let's go down here to the other indicator that we have, which is the slow stochastic. And we can see that we're approaching overbought. So that would indicate that we might want to just watch the stock a little bit, look for a sell-off. And there, incidentally, I believe the market is extremely extended right now. There will be a sell-off. It's just a matter of time. You don't want to be too anxious to buy stock. That's when you make mistakes. In fact, you want to be very patient. Okay? We look at the relative strength. That's trending toward overbought. The momentum, it's up in the overbought area because it has had tremendous momentum in the last few weeks. And then here, the money flow, this above 50 indicates that there is the net flow of money is into the stock. Okay, so those are our technical indicators. So let's go back to the main screen, and we'll talk about where we're coming out on this. Okay, so where do we go from here? I believe that whether you buy it here or whether you wait a little bit, you're going to be okay in the long term. If you believe that the economy is going to improve following a vaccine, this is, in my view, a very good stock to play the recovery. Once people start driving again, once the airlines come back into service and we get up to full capacity again, once the travel business opens up, demand for oil is going to do nothing but go up. Now that's your capital appreciation play, but the reason I'm really buying this stock, I expect capital appreciation, but I'm buying it for the dividend, and I'm going to, whether it's in a retirement account or a regular account, I'm going to put it into a drip program, and every time I get paid those juicy dividends, I'm going to buy more stock, and that new stock that I buy is going to create more dividends, and it's going to compound on itself, and I'm going to get the beauty and wonder of the compounding effect. Now I just want to talk about a couple things that have happened in the news. I read the Wall Street Journal. I'm not advertising it, but in my opinion, if you want to be in investing, if you want to be in business, if you're a young executive, or if you're even a middle-aged or older executive, you have to be up to date on what's going on in the business world. And for my money, the Wall Street Journal is the best solution for that and the best source. It's one of the few newspapers that you can still purchase, whether online digitally or the paper version. It's the last bastion of true journalism. Many of the papers that I used to read when I was younger, the New York Times and other papers like that, I can't even stomach anymore because it's so biased and they have such an agenda. I find that the Wall Street Journal, while the news division is more liberal, and I guess you just can't get away from that, the editorial page has some great analysis, great differing views, and it just really helps me to keep my edge with respect to the business world. Anyway, there were two articles that caught my attention over the past week or so. One talked about something that confirmed my original analysis, and I encourage you in the description below, check out the original Exxon analysis, was that Darren Woods and also the Chevron CEO both said that one of the tools they have available to them to maintain the dividend is to slash CapEx. This article in the journal talked about how Chevron and Exxon Mobil were both dramatically slashing their CapEx. It didn't specifically say to keep paying the dividend, but we know from our analysis that that is one of the main reasons they are doing that. In this article, Chevron's cutting its CapEx about 26%, and Exxon is reducing its CapEx $5 billion per year. That will do two things. It will enable us to continue to receive the dividend, and it will also help them to increase their profitability during this tough time. Another thing that came to light, which I thought was interesting, is this small group who only has a $40 million investment in Exxon Mobil co-opted CalPERS, which is the large pension fund, teachers' pension fund in California. This person, whoever it is, co-opted the large pension fund, who has about $300 million invested in Exxon Mobil, and they're trying to do a play with Exxon, sort of an activist play to try to get them to move more into alternative energies and renewable energy sources. I think this is a little bit humorous because the main actor in this only has a $40 million investment in Exxon, and I got to tell you, I know individuals that can invest more than $40 million in Exxon. So he's not a big player. One of the things I actually like about Chevron and Exxon is they were two of the last holdouts to not jump on this bandwagon of renewable and sustainable energy. And the way I think about that is let BP and everybody else go out and invest all this money in renewable energy and compete with the world on it. And you know, let Chevron and Exxon just stick with the basic blocking and tackling of the energy business. I'm perfectly fine with that. So anyway, stick to your guns. Exxon and Chevron are still fantastic plays, great value plays, great dividend plays, and a great turnaround play. Which one you go with is up to your own taste, but they're both great ideas and great things for you to look at. So I'm going to be putting up two videos here. I'm going to be putting up the original Exxon Mobil analysis, which you should definitely take a look at to get the background of some of the things I'm talking about here. And then I'm going to put another one up here that will be of interest to you. So watch them both and stay tuned, and don't forget to like this video and also subscribe so you can be on board for future videos that'll be coming very soon.